One of the things that always bugged me when I first started in this business of financial planning and financial services was it always seemed like we get this horrible economic news and then markets would go up, or a company would lay off employees and then their stock price would go up. And it always seemed very counterintuitive to me. Why is it that bad news often results in the equities and stock market increasing in value? And it took a while for me to figure all that out. And so I wanted to share with you kind of two principles that are guiding that perspective. The first principle is that we value a share of stock, and we value that at the present value of what we expect its future earnings and future value to be. So, for example, let's walk through this. If a company lets go of 1,000 employees, that is truly bad news for those 1,000 employees, and there's no question about it. But what might happen then is the cost that that company incurs goes down. And if their costs go down, their possibility for revenue goes up. And so what's happening then is the market is saying, okay, this company now has fewer costs. We believe they can be as efficient most of the time. And so now we're going to increase the present value of those future cash flows, right? So that's why on a company specific basis, you often see bumps when you have news of layoffs and that kind of thing. But the market as a whole is a little more puzzling to me. And there's a few steps to get to. So let's walk through what those are. Often we may have, let's say, bad unemployment news or bad production news or a drop in gross domestic product. And so what that triggers is a series of dominoes that winds up, and the result quite often is that you do have a market block. Because what is happening in the background is we have a group called the Federal Reserve. And the Federal Reserve sets a discount rate, in other words, a rate that it's willing to lend large institutional banks money at. And when you have bad news on a big economic cycle come in, enough of it, the Fed may be like, well, let's go ahead and lower rates because we need to stimulate this economy. So sometimes if you have really bad news come in, let's say that unemployment is going up, the Fed may say, okay, well, let's cut rates and hopefully that'll get things moving in the right direction. So that Federal Reserve often reacts to large bits of bad news, or we expect it to react, and then you see these bumps in the market. Because if the Fed does cut that discount rate, it trickles through where companies could theoretically borrow money cheaper, be more productive, and then you see their values go up. So in a nutshell, that's your answer. Often you have bad news come in, markets go up, and a lot of that has to do with interest rates we can borrow money at. It's a bit complicated, but if you watch it for a few years, it'll start to make a lot more sense.